Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. We are firmly in rugby season, and that means we are all lon the Springboks. And why wouldn't we be with their track record? But in the markets, patriotism alongside track record can get you into serious trouble. Every single stock needs to be assessed individually, and sometimes the right answer might be to go short rather than long. Yes, that means to bet on the price going down. Now, before you think you've lost your mind when you read the heading of this podcast and noted Cashbuild versus Mr. Price, they aren't direct competitors. I promise that you haven't missed the inclusion of clothes among the timber or tools among the yuppie chef kitchenware. All is well in the world. But they do, however, make for a rather interesting comparison in terms of current market dynamics and ways to play the local market for those who enjoy single stock exposure. In particular, if you are prepared to take a short position in your trading portfolio, then the recent Government of National Unity or New Inspired rally raises some very interesting questions around some of the local names and whether they've actually become a little bit expensive. The long idea that we will be talking about on this podcast is Cashbuild. Cashbuild's share price is down roughly 37% over 5 years. The company was initially a beneficiary of the stay home and stay safe regime, with the share price trading above pre-pandemic levels by early 2021 as people invested in their homes. After peaking at over 334 Rand per share, it now finds itself all the way down at 163 Rand per share at time of writing, a halving of value versus the pandemic highs. There are a number of reasons for this, including some of the most frustrating risks in South Africa, like the terrible riots in 2021. This had a significant impact not just on Cashbuild, but on South African consumers and their willingness to invest in fixed assets in South Africa. But the problems went well beyond just the riots, though. There are two other major factors that drove the downturn at Cashbuild. The first is consumer discretionary spending, or simply the lack thereof. With interest rates having moved higher at a rapid rate, the spare cash that consumers had left in their monthly budgets was quickly eaten up by debt costs. This led to far more selective spending, with the double whammy of consumers prioritizing travel experiences rather than home improvements as the world reopened. The second factor was load shedding, which had the dual impact of firstly crushing sentiment and willingness to invest in South Africa once more. We all know the fun stops at stage 6. And secondly, forcing affluent homeowners to invest in solar rather than other property improvement projects that Cashbuild would traditionally be involved in. It was the perfect storm, really. And in assessing whether Cashbuild could be a lucrative near-term play, we need to determine whether the conditions that broke the share price have largely disappeared. Let's start with riots. Well, we got through a landmark election without any unrest, so I'm going to take the optimistic route here and give that a tick in the box. I think that the worries around South African stability have abated to some extent. Interest rates? Unfortunately, not yet. There's no relief there right now. They are still high and still putting South African budgets under pressure. The worst is behind us though, with the trajectory for rates being downwards from here. We just have to be patient for the cutting to start. Load shedding? Well, we've now had over 100 days without the disappointment of flicking the light switch and seeing nothing happen. Solar installers are really struggling at the moment, which tells me that South Africans were mainly investing in solar in response to load shedding, not because they've always dreamed of having panels on the roof. And what about the travel bug? Well, a look at any global travel business reveals that travel demand does remain strong. But it does also feel like the surge in travel in the aftermath of the pandemic has normalized. People will always want to travel, obviously, but they've gotten over that pain of being locked up for an extended period. From my perspective, there are decent reasons to believe that the suffering at Cashbuild might be over. The signs were already there in the operational update released back in April, which reflected year-on-year growth of 3% in the third quarter, a rate above selling price inflation, which means positive volumes. I don't expect that the month or two before the elections went particularly well because we know that people were sitting on their hands, and we know this from reading results from cement companies and from the banks. But the rest of this year must surely look brighter. And with a healthy balance sheet based on the December 2023 numbers, Cashbuild is in a solid position to invest into a period of strength. The share price is up 12% in the past month, so the market is not blind to this opportunity. We now move on to my short idea, which is Mr. Price. The apparel sector is a competitive bloodbath on a good day. The malls are filled with different stores that are all selling you basically the same thing, a way to avoid being naked in public. The prices may vary along with the egos of the consumers involved, but the overarching point here is that the products are easily substituted for cheaper clothes in tough times or more upmarket clothes when things are going well. As we've seen at Nike on the global stage, a brand simply is not enough. Nike made some risky decisions around their distribution strategy that have proven to be problematic with the benefit of hindsight. Strong distribution and a smart strategy are needed in this space. The brand doesn't get you very far by itself. Now, it feels to me at least like Mr. Price is in strategic no man's land at the moment. Pepcore is clearly focusing on credit sales and doing a great job of that, building out a strong competency in driving such sales across the footprint. At the Foschini Group, key strategic areas of focus include the localization of the supply chain and the ongoing push into online sales through Bash, an aggregated platform that delivers an online route to market for all the brands in the TFG stable. At Truworths and Woolworths, there are a number of strong clothing brands that speak to a more upmarket consumer, looking for the right mix of names and quality. And Pick n Pay Clothing has made great strides in the value fashion market, which means delivering decent quality clothing at sensible prices. As for Mr. Price, they've been busy with acquisitions to try and grow the group beyond the core fashion offering. It is very debatable whether this strategy is coherent though, with the acquisition of Yuppie Chef as an example of a high LSM consumer focus, and the Power Fashion deal speaking to a value strategy of note, coming in at price points below Mr. Price's clothing offerings. The Studio 88 acquisition is a step into brands, which means aspirational customers looking to spend more on their clothing. In principle, I have no problem with retailers branching beyond their core businesses and making acquisitions. The thing I struggle with is the strategic thread holding it all together at Mr. Price. They are facing unprecedented competition from the likes of Shein and Temu, with online sales actually down at Mr. Price in the 52 weeks to March 2024. Although they reported a strong second half to that financial year, I'm unconvinced that momentum will continue there. And on a price earnings multiple in the mid-teens, there is a lot of growth baked into the Mr. Price share price. As a final sign for me that the recent rally has gone too far, the co-founder of Mr. Price, Stuart Cohen, recently sold nearly 42 million rands worth of shares. At time of writing, the share price is up 13.4% in the past month, but it's down 4% in the past 5 days, so it looks like it might be rolling over there. And as opportunities to take short positions go, this is one of the more interesting ones in my view. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.